In this case study, we will look at the various equity investment options we can apply. There are 4 options I would like us to focus on. We have an option where the equity investor can cover the gap portion of the senior loan, and this would be giving them the advantage of having a short term for this investment like a bank would, up to 2 years, getting an interest kind of payment like a bank would, and basically getting that paid deducted from the loan amount that we would be receiving. They would be recouping in first position, and they would have the option to file a lien against the movie in case of a default. The second option I would like to talk to you is to give the equity what I call ring fencers. These are territories that I will be removing from the collateral pool that I would give the bank in order to provide gap financing to me. So these are smaller territories the bank would be comfortable releasing, and the equity investor will have the advantage of recouping parallel in the waterfall with the bank in first position. The other option we are looking at would be where the equity investor invests some of their money also in a junior loan / mezzanine position. So in that case, they would also be able to charge like an interest-like fee, like an investment fee if you want, that they get to deduct from the investment. They can also put a portion of that in the waterfall, and it's usually a higher fee than what we would pay for a gap version of an investment that the investor would do. The term is usually longer, and the investor would have the option to file a lien against the movie in case of a default. It's a second position lien. You can think of it like a second mortgage if you want. And then we have an option where an equity investor would be a P&A investor, last money in, first money out, and they would be recouping from US box office and would be recouping in first position from box office revenues. We're going to look at all these 4 scenarios next. Let's look at the first version where the equity invests in the gap position of a film. We have a film here that is budgeted at $3 million, and we're going to assume that the international distribution revenues will be 75% of that. 75% of $3 million would be $2,250,000. That is the assumption we're making in order to receive distribution revenues with this $3 million film. So that's a valuation, that's a projection. We're also projecting that the US distribution revenues will generate 35% of the budget. 35% of $3 million is $1,050,000, and that again is a projection of what the film can make. Later, when we see the revenue column and the revenue plan, we will see that these projections will actually turn out to be reality. So we'll look at the recoupment schedule in a moment, and that's where we find this to be applicable. Let's look at our loan portion. The senior loan is comprised of a pre-sale loan and a gap loan normally. This would be something that is done by a bank or a bank-like lender if you want. In our situation, we're going to do the pre-sales with a bank. They will give us a loan for that. So let's look at the loan. We have pre-sales of 35% of the budget. That is $1,050,000. The bank in this scenario will not apply any discount. They will give us the full value of the contracts, of the pre-sale contracts. So they will cash flow $1,050,000. However, our distributors make a down payment at the time they are signing this pre-sale agreement, and that is usually 20%. This 20%, which is 20% of $1,050,000, in this case $210,000, is held by the sales agent until such time where we have all the other money for this movie raised, and the bond company will issue a completion bond insurance on the film and then release the monies we have raised to us in accordance with a production cash flow plan that they will approve. Now back to our pre-sale loan. The pre-sale lender here, the bank, will reserve an interest reserve of 8%, which is basically what they would charge up front in order to give us this pre-sale loan. So if we have $840,000 of a gross loan amount, that is again $1,050,000 minus the down payment that the distributors gave us. We are looking at an interest of 8% of that, which is $67,200, and that will be deducted from the $840,000 loan gross amount, which will leave us with the pre-sale loan net of $772,800. So that's what we will get for the pre-sales of $1,050,000. Next would be the gap loan. Here we have to look at the collateral that's available. And the collateral that we see here is the unsold rights. So when we have a movie that generates $2,250,000 in unsold rights international, and we are deducting our pre-sales from that, which were $1,050,000, we are left with unsold rights of $1,200,000. We're only looking at the international collateral in this case because banks do not consider US distribution estimates as viable, as bankable in that sense, because they're too volatile. So when we work with the bank, they will only ever look at the international distribution revenue number in the take, meaning the low column. So we have unsold rights of $1,200,000, I'm sorry, which again is $2,250,000 minus the pre-sales of $1,050,000. The equity investor would look at this and say, well, I'm going to do what a bank would do, and I will give you 50% of the unsold rights collateral. So that would be 50% of $1,200,000. In this case, $600,000. The lender or the bank would normally charge an interest reserve of a certain percentage, and they may not charge everything up front. They may charge something in the waterfall later. But in this case, the equity investor says, well, I want to charge a fee of 12%, and I want to consider the fact that it's going to take 3 years for me to make my money back. So I will take an interest charge as a reserve of 36%. Now, if we would pay this loan back earlier, this would be something that would be less and would be basically paid back to us, given what actual interest would have to be accrued until that time. So if we pay the loan back in 2 years, we could also ask for a portion of this interest back, just to give you background on this. But many investors would like to see this paid in advance because they want to make sure that they're not kept hanging with this and never get their interest. But you do have the option to negotiate with them to say, guess what? I'll give you an interest reserve of 12%, and like what a bank would do for 1 year, and I'll give you the balance of 24% in the waterfall. That's a conversation you can have with an equity investor, and they may or may not agree to that. They'll also look at a loan fee. Normally, a loan fee and legal fee is something that the bank will also charge us. And so in this case, the equity investor says, well, I'm going to do the same thing. I'm going to charge you a loan fee and a legal fee because I have to pay for a lawyer, and that's going to cost me money, and I want to get reimbursed for this. So they're charging us $50,000 mainly for their legal fees. That's what it's mostly is for. So when I deduct all these fees, I will be left with $334,000 that will be given to me to cover my production cost from this section. So altogether, we have to pay back the bank the pre-sale loan amount, the gross number that includes the interest of $840,000, and we have to pay back the investor their investment of $600,000 because that includes the interest. Now, when we are looking at the amounts that we get net, we get a pre-sale loan of $772,800 and a gap investment of $334,000. So those things will be the portion that is covered, help us cover the production costs. So now let's look at the other finance sources. So here we're looking at the next version of the follow-up version of the finance plan that we just started with, another way to raise money would be an incentive loan. So we would shoot in a region where they will look at our budget and say, we would give you a certain amount, a certain percentage of this budget as an incentive that you don't have to pay back. And when I say we, it's the film office or the related entities in a territory or country that supports film production by giving money to the producer that they don't have to pay back. So in this case, we get a production incentive of 25% of the budget. We will take this to a bank or a lender, and they will advance us money. They will give us a loan. They will charge us a fee. Normally right now it's around 12%. And in this example, I'm not going to list a legal fee or an executive producer fee for this lender, which sometimes you can find. So that's why I put it here, because it's sometimes a negotiation you can have with this production incentive lender to say, well, you know, I want to only pay this much legal fee and this much executive producer fee. I don't want to pay it at all. So you have that option, because those are the deals that you will find around today, where you pay nothing or you pay something. So if I'm deducting the 12% lender interest charge, if you want, we are looking at $660,000 that we can get from the incentive region and do not have to pay back. Brand integration is also something that we can help our movie with, where we work with an agency, an advertising agency, and their various brands that they represent, and see if our movie is in the same alignment in regards to the messaging that the brand has, and if the brand feels working with us will elevate their sales numbers of the products that they will put into our movie in a very organically integrated way. So here we are looking at 15% of a sponsorship amount. 15% of the budget is $450,000, and the agency, the advertising agency that helps us with this, or the, I would say, placement agency if you want, they will charge 10%, which is $45,000, so we are left with $405,000. The fees for such an agency, they vary. Sometimes they're 10, sometimes they're 15%, sometimes there is an advance payment due that can go against this percentage. So the way they charge really has to do with who you're working with and how they're working. And this is all based on negotiation. The other thing I want to mention here is that the sponsorship amount net could also be paid to us in 2 installments, where they pay 50% on closing, meaning when the bond company insures the film, and then the other 50% they pay in the waterfall, which would then be added to our recoupment, to our revenues in the recoupment plan. So those are the 2 payment options that you will find in the world out there when you are talking to brands and agencies about brand integration. So altogether we have raised $2,381,800, which means we have to have an equity investment amount of $618,200 to make it to $3 million and cover our full production budget. So here we are looking at the recoupment schedule, which we also refer to as the waterfall. We're going to pay the collection agent, which is a neutral escrow-like agency, to collect all the distribution revenues from international and the US, and they will hold on to them and manage them and pay back the lender if they get paid through the collection account. Sometimes they don't. They pay back the pre-sale loan, the gap investment. They pay back any costs that are related to that. They would pay back also, they would pay also any interest charges that may be due in the waterfall. They would pay back, they would pay the sales agency fees and expenses for the international sales agent, as well as the entity that manages US distribution, which can be a talent agency or a US distributor that does only US distribution. They charge a fee. It's usually somewhere between 5 and 10% is what we're seeing. And the sales agency expenses, they're usually anywhere from 7.5% to 25%, depending on what kind of movie you have and depending on what kind of budget level you're operating in. So then we have the equity investment that is being paid back here of 618,200, and it is industry standard to give the equity investor a 20% premium on that investment, which is 123,640. So we paid the collection agent 1% of what hit the collection account. And what hit the collection account is $3,090,000. And that is our $2,250,000 from international. We're deducting the $210,000 here because we already received it. So we are looking at international revenues of $2,040,000. We're looking at US revenues of $1,050,000, and that gets us to $3,090,000. And that is why the collection agent gets paid $30,900. We know that the equity investor invested $600,000. We know that our pre-sale loan was $840,000, so we're paying that back. And then again, we're paying the sales agency fee for international. 12.5% of $2,250,000 would be $281,250. 5% of $1,050,000, which is US distribution, would be $52,500. And then we have the equity and the premium. Altogether, our expenses would be $2,546,490, which leaves us with a net revenue of $543,510 on this movie. So now we have to figure out what is the ROI for the investor. And we're looking at the charges that they have charged us for the gap investment. We're looking at the equity investment premium, and we're looking at the profit participation. Those are the three things that our investor, or the three revenues that our investor would receive. Those are the payments we would get them. So let's first look at what is the profit participation. Now earlier you saw that the equity investor gave us around 20%, and the equity investor profit participation is driven by 50% of the percentage in the production budget that they have invested. So if, let's say, the equity investor invests 20% of your budget, their profit participation would be 10%. If the equity investor invests 30% of your budget, their profit participation would be 15%, and so forth. So in this case, our equity investor profit participation payment would be 10.3% of the revenues, the net revenues, which is $543,510. So that's the profit that we have to allocate to the equity investor as their profit participation. Now we're looking at what have they given us in investments. They made a gap investment of $600,000, and they made an equity investment of $618,200. So altogether, the investment that the equity investor made with us in this film is $1,218,200. So $1,218,200 is the money they gave us. And that's important for us to remember because our ROI will be reflective of this investment amount. How much money did they make in relation to the investment they gave us? So when we're looking at the gap charges that they charged us, we are looking at $216,000 that we paid them. The loan and legal fees were $50,000. They also received that. They get a premium on their investment, 20% of $618,200, which was $123,640. So they get that too. And then they get the profits that we just saw up there, $55,999.65. So we have it all to the dollar and cents here. So altogether, they are receiving $445,000, $445,639.65. That's what they're getting. That's what they're generating in connection with the investment they gave us of $1,218,200. That reflects an ROI on the investment of 36.58% in this investment scenario. So in this next equity investment option, we have an investor who says, I don't want any gap in the finance structure. I do not want anyone to recoup in front of me. I will be okay with pre-sales because they also help me to verify the market demand of this film and verify its validity in the marketplace, but I don't want a bank to charge gap because I want to recoup in first position. So in this case, what happens is we're not going to have a gap loan with the bank, and instead the equity investment will be increased. So let's take a look at what that means. So again, it's the same budget, $3 million. We're sticking with $3 million to have a good comparison throughout all these scenarios. So we're again making $3,300,000 in worldwide distribution. That hasn't changed. The pre-sales have not changed because it's the same pre-sales at $1,050,000. We have the same down payment applicable that the bank will deduct of $210,000. We have the same interest reserve. So the pre-sale loan has not changed. It is $772,800. There is no gap loan here. So those are the two monies we're getting. From the bank is the down payment from the distributors, and then the pre-sale net loan. It hasn't changed in relation to the other scenario we just saw. So in this scenario here, what has also not changed is the production incentive loan because it's the same film. We're producing it in the same region. Nothing has changed here. So we get $660,000 from the incentive region that we do not have to pay back. The sponsorship also hasn't changed. It's the same film, so the sponsorships will be the same. Now the equity investment here you see is higher. It's now 31.74% because the investor does not want a gap loan to be part of the finance plan. That means they have to give us more money in order for us to cover the $3 million budget. So in this scenario, they're giving us $952,200 as the equity investment that they make, that they give us in order for us to make the $3 million round and cover the budget. Let's take a look at the recoupment schedule here. We have the same revenues applicable, $3,090,000, so nothing has changed there. The collection agent will get the same amount, $30,900. There is no gap. There is no equity investor investing any gap. There is no bank applying any gap. So that is going to be zero. We do have the pre-sale loan that we have to pay back. That is $840,000. That's the gross loan amount. We are paying the same fees to the international sales agent and the US agent because they generated the same amount of revenues for us, so that has not changed either. The equity investment has, however, changed here because that amount has increased to $952,200. We will also be paying a 20% premium on that. 20% of $952,200 is $190,440. So that amount is higher. So we are looking at $742,710 here as our net revenues if we are taking all the expenses and we're deducting them from the revenues. So now let's see what the ROI for the investor would look like. So in this scenario, the profit participation has jumped up to 15.87% of the net revenues. So that is $117,868.08. They gave us more money in regards to the budget. They covered a larger portion, so the profit participation is also larger. What did they give us in investments? They did not give us a gap investment. They only gave us equity. So that's the amount we're looking at. And then what are they receiving? They're receiving premium and profits. That is $308,308.08. So if we look at, comparing that to the investment they gave us, we're running an ROI here of 32.38%. Let's look at another structure that could be beneficial to our equity investors, and that would be that we secure ring fencers for them. We remove collateral from the bank's collateral or the lender's collateral, and that would be the ring fencers. These are usually smaller territories that the bank would not be hesitant to release. If they would be big territories that they really need for their collateral, that they need for the risk coverage, they would not agree to this. But if it's a few small territories, they will usually let them go, and the equity investor can benefit from those revenues because they are paid parallel in first position, parallel to when the bank is recouping. So that's basically a split waterfall between the bank recouping the senior loan and the equity investor benefiting from these ring fencer sales. So that's a parallel waterfall that we will find. In this case, we have the same budget, $3 million. The estimates are slightly changing because the estimates that we would see would be deducting the ring fencer. So the unsold rights would be lower, which would then mean that the gap loan the bank will give us would be lower, because we cannot tell the bank you're going to get the full collateral because we took ring fencers out. So when they give us a gap loan, they would say, well, we're only looking at the collateral that we have available, and we're going to give you 50% of the unsold rights of that collateral that is left for us after you took the ring fencers out and assigned them to the equity investor. So there will be a little less in ring fencer money if you want, and a little less in collateral, meaning a little less in gap loan if you want. That's really what I wanted to say. So the pre-sales are the same, nothing has changed here. What the bank will do though is they're going to charge us an interest that is blended. So in this case study, I want you to look at what happens if the bank A discounts some of their pre-sales, and B, if they're going to blend the interest reserve, the interest between gap and pre-sales, and then charge us 15% for 1 year and charge us the second year in the waterfall. They'll also charge us a loan fee. So in this scenario now, I'm giving you a little more to think about. The gap is, as I said, will be 50% of the unsold rights minus the ring fencers. We will have a junior loan in here of 5% of the budget. They're charging us a fee of 15%. We will have an incentive loan of 20%. In this case, we're splitting it up, and you'll find that a lot too, between above the line and below the line. So some incentive regions do not give us the same percentage on the entire budget. They look at the budget and say, well, I'm giving you this much for the above the line costs, and I'm going to give you this much for the below the line costs. So those can happen, that application can happen depending on what incentive region you go to make the movie. The lender will charge the same, it's 12%. That's a pretty industry standard fee, as I mentioned before. We're going to add a few things in non-recoupable finance sources here. We're going to have a music publishing company, or music investment company, I should say, pre-buy the music publishing rights from us, and they pay us 1% of the budget. So they're basically saying, you have some music in the movie, we like it, we're pre-buying your publishing rights, and we'll give you money for that. We're going to have a brand integration company here that will be applicable, give us 5% of the budget, and the agency will now charge 15%. So it's a little higher, which can happen. Agencies can charge 15%. So I wanted you to look at what that scenario will be. And then we have some crowdfunding here of 1%. Sometimes people do crowdfunding not just because of the money they can raise, but also because they want to create awareness for the film early on. And crowdfunding is a great option to do that. We're going to also have some deferments here. A post-production house will defer 3% of the budget from their post-production costs into the waterfall, and the visual effects house will give us 2% of the budget as their costs, and they're going to be paid in the waterfall. And because they're taking a little risk here, they're going to charge us a premium of 10% on this deferment. And then the balance will be covered by the equity under industry standard terms. So nothing has changed in regards to the terms that we're applying here for the equity. And then the collection agent will charge us 1%. the international distribution company or sales agent in this case will charge us 10% on all the international rights that are generated, and the US agent charges us 5%. We have some profits here that are not just given to the equity investor, but we also now give profits to the cast. Our lead cast is going to get 20% of profits. The director is going to get 15% of profits. We have a co-producer that gets 10% of profits. So sometimes, depending on where we're shooting and if we hire someone locally to do the work, and if they actually help us even to generate money from the region, that could be worth a profit participation in this case. Or maybe they do something else to help us with the film, provide some financing, provide a great distribution deal. Whatever we do with the co-producer that is benefiting our project is something that we should consider when we put the project together, and sometimes these people participate in profit. So I wanted you to look at a scenario where we apply all the things that you could find in the world of film financing. So we're applying different things here now, but we're going to give the equity investor the option to recoup in first position from territories that we will remove to their benefit. So let's look at this finance plan with all the bells and whistles and see what the ROI is for our investor in this situation. So here we're looking at sales estimates, and they are particularly interesting to us in this situation because we need to look at the actual case here. So we have pre-sales that we have generated, and that's about 35%. The number here is 1,039,500. So the percentages are rounded up, but the actual pre-sale number that we have generated for the film is 1,039,500. The little territories that we have assigned to the equity investor are listed here as well. So you see there is the Chinese territory that's assigned to the equity investor for $3,000. That's what we would be making under this movie, is what our estimate is. So we're assigning that to the equity investor to say we're projecting that you can make $3,000 from China, we can make $3,000 from Hong Kong, we can make some money from India, Indonesia, it looks like it's Malaysia here, then we have the Philippines and Singapore looks like. So we have all these various territories that we have removed, and we are told by our sales agents that this is kind of the value that they would assign to them for this particular movie, with this particular script, with the particular director, and the particular cast, and this particular genre. It very much varies, of course, every time when we have sales estimates, what the movie is about, what the budget is, who the cast and director are, and what genre it is. So these numbers will change greatly depending on what you have. Is the script good? Is the genre delivered on? Do we have strong cast? What is the track record here with the director, etc.? So these things are important. So for this movie, particularly this movie, we are given these sales estimates as projections from our sales agent, and they will project the ring fencer numbers to be $48,000, which is roughly 1.6% of the movie. So what that means is our unsold rights will basically be 1,162,500 if I'm excluding the ring fences of $48,000. And that number will be important later when we look at our gap loan, because the gap loan will be 50% of 1,162,500. So that's what we need to look at. Let's take a look at our finance plan. So what we're seeing here now is the separation of above the line and below the line, so we can allocate later what the incentive loan would look like. So we have a $3 million budget. We're spending $1,050,000 in the above the line and $1,950,000 in the below the line, and then we have a total budget of $3 million. The projected international sales estimates are $2,250,000, and the US projection for distribution revenues is $1,050,000. So together we are projecting we're making $3,300,000. However, of that, we're going to allocate $48,000 as ring fencers to our investor, leaving us with unsold rights of 1,162,500. So our pre-sales actually come down to exactly 1,039,500, and the down payment of that is 270,900, leaving us with a balance due on delivery, what the distributors have to pay, of 831,600. Now, after pre-sales, the bank says, well, while there are tier 1 pre-sales, there are some buggers in there that I'm not crazy about, just a few. So I'm going to discount your pre-sales and give you 90% of your contract value. 90% of 1,039,500 is 935,550. You will find that banks may apply discounting in relation to your pre-sale contracts if there is maybe one or two distributors that they have a spotty payment record with. So 90% is still pretty high, which doesn't really, give us a sign that there are troublemakers in our pre-sale buyers, but the bank feels like a little bit of discounting is applicable. So that's what they're going to do. 90% is what they're going to give us of the contracts. The down payment is still 207,900 because the down payment is driven by the 1,039,500, which is what we actually pre-sold. And the 207,900 is what the distributors gave us as their first down payment on the pre-sales that we have generated. So the bank will deduct this because we received it already. So then they're looking at 727,650 at the loan amount that they will give us. 50% of the unsold rights minus the ring fencers, which is 50% of 1,162,500, would be 581,250, which is the gap loan that they will allow. So the senior loan gross would then be a total of 1,308,900. So they will apply the interest rate of year 1 and deduct it. And it's a blended rate between those two forms of lending, pre-sale and gap. They'll deduct 15%. 15% of 1,308,900 is 196,335. They also apply a loan fee of 2.5%. 2.5% of the loan amount is 32,723. So altogether, what we're getting as a senior loan that we can cover a portion of our budget with is 1,079,843. Let's continue with our finance plan here. Next, we have a junior loan investment of 5% of the budget. 5% of $3 million is $150,000. The loan fees that are being charged here is 15%, so that is $22,500. It's actually a pretty good deal. So $127,500 is the net amount we will be receiving from the junior lender. The incentive now is going to be broken down between above the line and below the line. 20% of the above the line number that we have broken down in our budget allocation is 210,000. 30% of the below the line portion of the budget is 585,000. So altogether, the incentive region will allow an allocation for us for a movie of $795,000. The lender will charge us a fee of 12% on that amount. 12% of 795,000 is 95,400. And the amount we receive then net to cover our budget is 699,600. So that is the incentive amount that we receive from the incentive region that we don't have to pay back. The incentive region is going to pay the lender, and the lender is giving us a loan, but we don't have to pay it back because the incentive region is paying it directly to the lender. So we have some NRs, which is a short word for non-recoverable finance sources here. We're giving the music publishing company some of our publishing rights, could be some, could be all. That's something we can negotiate. They're giving us $30,000 for the publishing rights that we will give them. Then we have a brand sponsorship that is applicable here of $150,000, 5% of the budget. And then we have the agency charging us 15% of that. So that is 127,000. Hold on, 15% of 150,000 is 22,500. So altogether, we will be getting 127,500 from the brand as a net number to us. And then the crowdfunding that we generated for this movie is $30,000, and altogether on non-recoupable finance sources will give us 187,500, and that's what we use to cover a portion of our budget. And then we have the post-production and visual effects components here. The post-production is deferring $90,000 of their cost into the waterfall, and the visual effects house is deferring 2% of their cost, 2% of the budget, and 60,000 of their cost into the waterfall. So altogether, $150,000 is deferred into the waterfall to be paid there. Now there's two ways to go about this investment. One way is we're going to take the $150,000 and we reduce our budget by that number. So the budget would automatically come down from 3 million to, what is it, 2,850,000, if I'm calculating this correctly. So the point here is that I'm trying to make is you can work this finance plan in two ways, where you say, I'm not putting the 150,000 in the balance column here as a portion of what is being covered by a finance source. I'm reducing my budget to a strike price. The advantage of reducing your budget to a strike price, and you can do that because the post house and the visual effects house are giving you $150,000, which were line itemed in your budget and are not payable now. So you can actually reduce your budget by this number. And the advantage is that your completion bond fees will be driven by that lower number. And because we're paying the completion bond often a percentage of what they're bonding, meaning a percentage of the budget in many cases, it helps us to reduce the budget by anything we're deferring, because we then pay less to the bond company as a fee. I kept it simple here because we're going through these various finance scenarios, and it's not really about how we're handling the budget and the bonder. It's really about what options have the equity investors to invest with us in our films. So this case study is driven by what are the options that our equity investor has versus how do we run the budget and the bonding process. We'll deal with that later, but for now let's focus on the equity investor finance options. So here, with all the investments and all the finance sources that we have comprised, we're basically seeing that our equity investment is covering 18.26% of the budget, and that will be 547,658. So let's take a look at our recoupment schedule here. The revenues total will be the same, 3,300,000, including the ring fencers, and that's fine because we are selling the ring fencers and they will be part of the distribution revenues. It's just how they will be paid in the waterfall is different. So let's start at the beginning. We have 3,092,100 because 3,300,000 was the original in the national distribution revenues, but our down payment is different because we're driving it by what the actual pre-sales are. And so 270,900 were the down payments of the actual pre-sales, leaving us with 3,092,100 being generated. Now what we do here now, which you see often too, and that's why I'm doing it, the senior lender wants to be paid directly outside of the collection account. We have no problem with that. We have no problem with the distributors paying the bank directly for the pre-sales, etc., and for the senior loan, because we will save money that we would pay to the collection agent. Because if I would pay $3,092,100, if I would pay 1% of that, that would be around $30,000. Now, because I'm paying the senior loan outside of the collection account, I'm saving money. So now the balance that is due after the senior loan has been paid back is $1,586,865, which means I'm paying about $15,000, meaning half, to the collection agent, $15,869, which is 1% of $1,586,865, which is the balance that we have after we pay the senior lender. Now, we paid the senior lender their senior loan and the second year interest. So altogether, we're paying them $1,505,235. So the second year interest will be applicable here in the waterfall, and we often find that. Now, this interest could be less if you pay the loan off, let's say, in 18 months instead of 24 months. So that number could be less because you're only paying the interest in connection with the time that it takes you to pay the loan off. So if you pay it early, you pay less. Okay, going to the collection account, we have, as I said, $15,869 paid to them. The distribution charges are 10% of what was received from what was generated by the international sales agent. Now, the international sales agent did sell also the ring fencers because they have to be sold by someone. And so the international distributor or the international sales agent will sell those too and charge their fee on that as well. 10% of $2,250,000 is therefore $225,000. The US is not impacted by anything, so the US is 5% of $1,050,000, and that is $52,500. Here we now see the post-production and the visual effects payments paid back at this time after the collection agent was paid, after the distribution charges was paid, and obviously after the senior loan was paid. So they gave us $150,000 in deferments, which we're now paying back, plus they're charging a premium of 10% of that. So that is 10% of $150,000, and that is $15,000. So we have to pay that back. And then we have to pay the junior lender back $150,000 and the equity investment $547,658, which was the investment they gave us, plus the premium on that amount, which is $109,532. You see here, I've not dealt with the ring fencers yet. I'm dealing with that when I'm looking at the equity investor portion of this structure. So you're going to see it coming up. So in this situation now we have net revenues of $321,307 based on the finance sources that we have applied, which are different than you saw in the earlier case study because I want to put in more things to get you used to more things. So here's where we're dealing with the ring fencers, etc. We're also dealing with other profit participants. So we have generated net revenues of $321,307, and we have a few people that are now looking into getting money. So we're giving 20% to the lead actor. 20% of $321,307 is $64,261. We're giving 10% to the co-producer. That is $32,131. We're giving 15% to the director. That is $48,196. And then we give the equity investor what they're owed, which is $29,328. So altogether, we are allocating $173,916 in profit participation payments, leaving the producer with 147,391 in profit participations. So let's look at the equity investor who gave us 547,658. They get the ring fencers of $48,000. They get those paid. And they get those paid alongside the first recoupment structure that the bank would get. Or maybe the ring fencers are sold after the bank has, been paid back. It is a question of, what is the sales agent doing? When are they selling the ring fencers? For us, we keep it simple here. We're going to just say the equity investor is getting them. $48,000 is what they're getting. We will be deducting $4,800, 10%, that is due to the sales agent because the investor will have to pay that as well as we do. So they're going to get that deducted. Then they have a premium of $109,532, which is the 20% we mentioned earlier. And then the profits we have listed up there is $29,328. So altogether, the equity investor is generating $182,059 with the investment of $547,658. So their ROI in this scenario would be 33%. In this next scenario, we have the equity also invest as a mezzanine investor. So budget is still the same. We are looking at our estimates and the sales sheet to apply the pre-sales, to apply the unsold rights, to apply US estimates, etc. So keep those estimates with you to make sure you run the right numbers based on them. So then what we see here is we have the sales sheet with our pre-sales. The buyers pay the 20% down payment. We still get a 90% discount from the bank, and the interest reserve is still 15%. So that has not changed in regards to the pre-sale. The lender components are the same. The gap, 50% of unsold rights, maximum 20% of the budget. So we need to look at what that gap is. What are these unsold rights? Then we have a junior loan of 5% with a 20% fee, where 3 years, actually it's actually 2 years, I'm going to fix that, will be added in the waterfall, because usually the loan is about 3 years, sometimes could be a little longer, maybe 4. I've never really seen, well, some people actually had it for 5 years, but that's kind of unusual. So between 3 to 5 years is the term you may find with mezzanine lenders. So in this case, we're going to apply 3 years altogether for this loan to get paid back to the junior lender. Then we have incentives of 20% of above the line, 30% of the loan below the line, and we have a loan with the incentive with 12%. That's the same than we had in the previous version. We also have the same in non-recoupable finance sources. Nothing has changed here. We don't have any different deferments from post and visual effects. Same one than we had in the previous study. And anything on the waterfall items and profit items is also still the same than what we saw in the earlier version. So there is not much changed here other than the fact that the equity investor is also investing as a mezzanine investor. So here we're looking at the sales estimates. We have altogether $2,250,000 from international projections, and we have $1,050,000 from the US. Our pre-sale number is $1,039,500. So not much has changed in the regard of sales estimates because it's the same movie. So here we have the same situation with the above the line, below the line allocation because our incentives have not changed. We're looking at revenues of $3,300,000 coming from the US and international as projections. The pre-sales are $1,039,500. Down payment is $207,900. So nothing has changed here. We get a 90% discount from the bank, leaving us with a pre-sale loan of $727,650 as the gross loan that we have to pay back. The unsold rights here are a little more because we don't have ring fences that we have to take out. So we have unsold rights of 1,210,500. The maximum for the budget would be a cap of 20% of the budget. So that's 600,000 for a $3 million movie. That is therefore the gap loan gross amount because the bank will not ever give us more than 20% of the budget. So we're looking at a total loan of 1,327,650. We are getting charged the first year interest of 15%, 199,148, and a 2.5% loan fee of 33,191. That leaves us with a senior loan net of 1,095,311 in this scenario. So now we have our investor invest as a junior lender. 5% of the budget is what they give us, and they're going to charge us the first year as a reserve, 20% of that. So we're paying 30% as an interest reserve on this mezzanine investment, leaving us with $120,000 from the investor net. They're going to keep the first 20%, and they're giving us $120,000 for the film. The incentive has not changed because it's 20% on the above the line, 30% of the below the line. We're paying 12% to the incentive lender that is giving us a loan for this incentive. So that means we have 699,600 as we had before coming from the incentive lender for the reason that we're shooting in an incentivized region. Incentive region is paying the lender back directly, so we don't have to do that. So the music publishing here has not changed. It's the same like before. We're selling some publishing rights here for the music to a music investment company for 1%. We are getting a brand sponsorship of 5% of the budget. We're paying the agency 15%. We're getting some crowdfunding in. So altogether, our non-recoverable finance sources for this section is 187,500. The post-production deferments are the same. We're getting post-production house to defer 90,000. We're getting the visual effects company to defer 60,000. So altogether, we are deferring $150,000 from that section. So the equity investment that we have here, then that we have to pay is 539,689, which is about 17.99, so roughly 18% of the budget in this situation. So again, we have the equity investor putting up equity, and we're having them put up a mezzanine investment as well. Now let's look at some of the other recoupment schedule items here. The recoupment for the distribution revenues would list 3,092,100 because we have, there's no difference here than in the picture before. It's the same movie, so our distribution revenues will be the same. It's nothing different. So we are recouping the senior loan again outside of the collection account, and we're now paying year 2 interest here. So we're paying the lender 1,526,798 for the gap loan portion and the pre-sale portion, leaving us with a balance of 1,565,303. So we're paying the collection agent 1% of that. We're also paying the distribution charges international 10% of what we sold, so that's the same. We have no charges on ring fences because there are no ring fences in this one. We pay the US, they are 5%, it's the same than we had before. And then also no difference in the deferments, 150,000 plus the 10% premium, 15,000. So none of that has changed. We are looking at the junior lender now, who's getting $150,000 paid back. That's our investor. Plus they get 2 years of interest totaling $40,000 here in the waterfall. So that's another $60,000 that we pay to them. and then we're paying back the equity investor and the premium. So altogether, our expenses for this version of the investment would be $2,842,577, leaving us with net revenues of $249,523. So now we have to look at the profits that are being allocated to the various profit participants. That's what we're going to do next. So in the last portion here, the profit participation portion, we have to share the $249,523 with our lead actor, our co-producer, our director, and our equity investor. So altogether, we're making profit payments to them of $134,729, leaving the producer with $114,749 in profit payments to them. So here's what's being paid to the equity investor after they invested $689,689. Now it's a round number. So they got interest charges in total, I should say, fees, not really interest, but fees in connection with the mezzanine investment of $90,000 total. They got $30,000 from the investment as when they did release it, and they got 2 years, $60,000 in the waterfall. They had a premium on the investment portion, the equity investment portion, of $107,938, and the equity investment portion also generated a profit for them of $22,444. So altogether, our payment to the equity investor would be $220,382, and in connection or in relation to the investment of $689,689 would be an ROI of 32% for this investment option. Now we're going to go a little more crazy even more. We're going to have a movie that is being released in the theaters, and we could use here a rent-a-studio deal structure, meaning we release it together with a studio and we raise P&A through our equity investor. So here's what's going to happen. Our $3 million movie will generate about $10 million in the box office. The theater owner is going to get 35% of that. The distribution fee that is paid to the studio is going to be 25%. And the P&A that's being invested by our equity investor is $1 million, and they're charging a fee on that P&A of 25%. So that's called last money in, first money out, because they will basically invest the P&A after the movie is finished, give it to the rent studio, give it to the studio that's handling the release for us, and they will then generate box office with the release of the film, and from that immediately our investor that gave us the P&A investment of $1 million is being paid back. That's how it normally works. And the P&A investor has to be recouping from the box office and US revenues. They cannot recoup from the international waterfall because that would not be allowed by the bank. So the international and US estimates are per the sales sheet. The pre-sales are as well, haven't changed at all from the previous scenario. The gap loan is not any different. The junior loan, not any different. The incentive loan is the same. The non-recoupable finance sources have not changed. The deferments to post and visual effects house have not changed. The balance is still paid by the equity investor for the equity portion. And then the collection agent and international distribution, as well as the US distribution fees, have not changed, nor have the profit participation components. So none of that has changed. The only thing we're going to focus on in this scenario is what happens if our equity investor invests P&A with us to release the film in the theaters. What would that look like? So here, the sales estimates have not changed, but I want you to look at the US, because the US is no longer listed in the sales estimates, because it is going to be a theatrical release that we control. So it's not something where a US agent is going to sell the movie. That is not applicable. So we can't put a projection in here because it's all going to be box office driven, and the release of the US rights will generate a distribution revenue that we cannot foresee right now. So that is why the US rights are left blank, and all you see here is the international components, and they have not changed from what we saw before, with 2,250,000 coming from international take on the low side for these distribution revenues, and the pre-sales will be 1,039,500. They have not changed as well. So the main difference here between this sales estimate sheet and the ones we had before is that we're not allocating any money to the US. So in this scenario, you see here that the above the line, below the line allocation is still the same movie. That is why it has not changed. The international revenues have not changed as well, nor has the down payment. And now we're looking at the US. So the box office that is being generated for this film is $10 million. The exhibitor, theater owner, will take 35% of that right off the top. That is $3,500,000. The balance that is then left after the theater owner took their percentage is $6,500,000. The distribution fee that the studio will charge is 25% of the box office that's been generated, so that is $2.5 million. So all of these things have to be deducted, of course, together with the P&A. Now the P&A investment that our investor will provide is $1 million, and the P&A fee that they're charging on this investment is $250,000. So altogether, when we deduct all these things that are being deducted here, that are being listed here, we end up with US revenues of $2,750,000. So that's what we're left with, and together with the international projections, we're looking at $4,792,100, and that is basically our revenue for the whole movie. Now that we've seen Aha, we went out into the theaters, we generated some box office there, we also sold our international revenues just as projected, and now we're looking at $4,792,100 in revenues from the US and international. That's what's going to be applicable later. Right now it's a projection, but it's going to be applicable later in the recoupment schedule that we're going to see. So now let's look at the finance plan here. The senior loan is going to be still giving us the same gap loan and the same pre-sale loan, so nothing has changed here than what we had in the previous scenario. So the loan amount that we get here is $1,095,311 after we paid our interest reserve and loan fee from the gross loan amount of $1,327,650. So that's going to be a senior loan together with the down payment here. This is the same information or the same situation than we had in our previous investment option. Now here's the rest of the finance plan. We have our junior loan, $150,000 minus the interest charges of $22,500, being $127,500, and the incentive loan also stays the same at $699,600. The non-recoupable finance sources have not changed. We're getting $187,500 from them, and we still have the post-production and visual effects house deferring $150,000. So this is all the same. Equity is giving us here $532,189 for this finance plan as it is right now. So here we're looking at the recoupment schedule. The net amount after we paid P&A fee, the exhibitors, and the studio was $2,750,000 for US distribution. So we're putting that net amount in here for our revenues. The international distribution revenues have not changed. They're still 2,250,000. So altogether for worldwide revenues, we have $5 million. We're deducting the down payment of $207,900 from the international that we already received, and so we have distribution revenues altogether from the world of $4,092,100, which is basically what we had projected earlier. We're paying our senior loan outside the collection account. The senior loan is the same. We're paying also the second year interest. So $1,526,798 is being deducted from the revenues of $4,792,100, leaving us a balance of $3,265,303. So now we're paying the collection agent 1% of that, which is $32,653. We're paying our international sales agent their 10%. 10% of $2,250,000 is $225,000. We're not paying anything to the US because we did a rent-a-studio deal, so that is $0. We're paying the deferments back to the post-production house and the visual effects house of $150,000 plus their premium of $15,000. We're paying the junior lender back $150,000. And then we're paying the equity investment and the premium. So altogether, we have $2,738,277 for expenses, which leaves us with a net revenue of $2,054,23. That is where we are right now with the scenario of a rent-a-studio theatrical release. So when we're looking at the revenue components here, with the situation where the equity also invests in P&A, we're looking at our net revenues of $2,054,23, which are then shared with the lead actor 20%, co-producer 10%, director 15%, and the equity investor 8.87. So we're paying a total of $1,106,498 to all these profit participants, leaving the producer with $947,525 as their in profit participation. So if we look at the equity investment of $1,532,108, which includes P&A and equity for the film, we are looking at the following payments that are due to the investor. The P&A fee was $250,000, so that's going to be paid to them. The premium on the equity that they gave for the production was $106,438, and the profit participation they received from this film is $182,188. So altogether, they're making $538,626 on this film, which reflects 35% in ROI if I run it against the investment that they gave us. So we ran through various scenarios for the equity investors, how they could invest, what they would receive as returns, and of course there are many other options that we could employ here. So these are just some examples of what we could offer to the equity investor as investment options. We could also say things where we say to the investor, well, you're giving us P&A and no equity, and then we have to massage the finance plan in a way that we don't have equity investment, which means we likely would have to go and shoot in an incentivized region that gives us more money, or we have to do a brand deal that's better than what we have, or maybe we have to do a better music deal. We somehow have to replace the equity that we're not getting. We could also do more pre-sales, but we have to obviously replace it in the finance plan if the equity investor says, for example, I'm only giving you P&A, or I'm only giving you mezzanine and not an equity. I'm only giving you um, an increased equity and no gap. So, I mean, we had that scenario and that actually worked out, but in the scenario where we wouldn't have equity in the film and they would just focus on another investment option instead of equity, we then have to massage the finance plan to make up that equity. So those are yet more options that we can run in connection with the equity investor options. So you can go ahead, because you have the Excel spreadsheets, and play around with them. Look at what would an option look like if I change this in any shape or form. What the goal would be here is that you reach an ROI that's definitely over 30% in that range, if you can, because the equity investor that invests with us in an option that is supposed to be more appealing to them would look for that. If they just do equity for the film and they're not doing anything in addition or something, then we can be in the 20%, above 20% range. But if the option is designed to get them more money, the focus is on getting them more money. So it would be somewhere, if you play with this Excel sheet, where you have to reach an option that will get them above 30%. So you can play around with the Excel sheets that I have sent you in the summary page and just adapt it to what you believe could be interesting to your investor. So these are templates you can use going forward in adjusting what you believe the appetite of the equity investor is that's sitting in front of you. What is their risk profile? How do they want to protect themselves? What kind of risk do they want to take? Where do they want to sit in the waterfall? All these things are conversations you can have with the equity investor, and you can adjust these finance plan options to what the investor is telling you. So you have a big, I should say, selection of options here, but you can even go ahead and change that even more. So that's why I'm giving you these templates, so you can play around with them and can have conversations with the various equity investors that might have different views or different risk appetite, and you can then offer them different things. So if you have any questions about this, email me via Canvas, or we can set up a one-on-one on one of the Saturdays where I offered office hours. So either way is fine. Feel free to reach out and let me know if there is anything unclear about this case study. Thank you.